Then I'm supposed to start. Or?
Ladies and gentlemen, thank you for joining us today and welcome to our session, Great Recession, Productivity Slowdown, and Business Dynamism. Without any further ado, please welcome our chair, Mr. Omar Licandro, to open the session. Mr. Omar Licandro, the screen is yours.
Thank you very much. Good morning, good afternoon, good night, depending where you are. It's a great pleasure and an honor for me to chair this excellent session. The first speaker today is Sina Ates, and Sina, the floor is yours.
Thank you, Omar. Okay, thank you all for joining the session today. And I want to start also thanking the organizers for putting up this outstanding conference despite the pandemic, surviving it for 1 year. Today, I'm going to talk about our joint work with a faculty from University of Chicago. And this is about the recent developments in US business dynamism. And just before I start, the usual board disclaimer about employees' work also applies here. Let me mention that. So a growing body of research has recently documented very striking trends over the past several decades in the US economy regarding firm dynamics. Like these include a steady decline in firm entry rates, a decline in labor share, but also an increase in market concentration, for instance, which can be possibly interlinked and suggest a decline in business dynamism and entrepreneurship in the US economy. And interestingly, some of these are also common to several developed economies of Europe. Of course, this has received attention from policy circles. For instance, just before the pandemic hit, the US Federal Trade Commission has held hearings on the changing nature of industrial competition and concentration. So motivated by this lively debate, we started actually from a fundamental question: what are the underlying mechanisms behind these trends? And in particular, could there be a common force that could jointly account for these observed trends? Of course, we would be interested in the implication of these trends and of our findings on how to conduct competition policy going forward. So to be able to answer these normative and positive questions, of course, you would need a theoretical framework that could speak to all of these observed empirical trends. And in our analysis, we aim to contrast a large set of empirical trends against many candidate explanations to be able to hopefully identify the strongest channels behind these developments. So to do so, we proceed in 4 steps. In our paper, we first gather a set of 10 prominent regularities on business dynamism over the past several decades, and then we build a quantitative theory based on Schumpeterian growth models. So the backbone of the model will be a step-by-step innovation framework, which will complement with endogenous entry of firms. The gist of these models, like the nice picture, is that they can successfully capture the competition between 2 incumbent rivals, like the strategic interaction between these firms. A best firm that can exercise some sort of market power, and the rest of the firms that are competing against this leader trying to capture the market. As a result, variables like market concentration, markups, etc., these evolve endogenously in response to firm decisions, which is a very desirable feature of the model. We complement this framework with an additional channel of knowledge diffusion. So you can think of this as an exogenous parameter with which followers can quickly catch up with the market frontier, with the leaders. So this is like a reduced form representation of like the intensity with which laggard firms learn from the frontier, or the intensity with which the ease with which they can apply what they have learned. And I'm going to emphasize this channel a lot because we're going to see in our results that this channel will play a key role in explaining the trends. So we take this model to the data. We calibrated it, especially focusing on the transitional period of the US economy. And then we run a horse race between alternative channels, potential explanatory channels. So these include policy parameters like corporate tax rates, R&D subsidies, or other structural parameters like entry barriers, knowledge diffusion. And we're going to highlight the significant role of knowledge diffusion if we want to understand this decline in business dynamism and a large set of its symptoms jointly together. And then if time allows, I'm going to finish today with some new empirical evidence documenting the declining knowledge diffusion or its symptoms in the US economy. So before I go to the model, let me review the facts or trends that we are focusing on. Of course, I'm not going to have time to go deeper into each. Let me summarize them briefly. So first, we, like many papers, have documented these facts, and let's start with the market concentration. So we observe that market concentration has been on the rise together with average markups in the economy and the aggregate profit share of GDP. So these together kind of highlight that market power for some firms in the economy might be on the rise. This happens together with a decline in labor share of output, and that is all happening in positive association with market concentration, so at the industry level. So the more concentrated an industry gets, the larger is the fall in labor share in that industry. Then we have some facts that are directly speaking to firm dynamics. First, we observe that the productivity gap between frontier and laggard firms has been widening. So the dispersion of TFP levels has been widening. We have the well-documented decline in firm entry rates together with a decline, of course, in the share of young firms in economic activity. We also observe that job relocation rate, which is an important gauge of business dynamism, has been trending down. And finally, we see that the dispersion of firm growth has been on decline. And this is kind of interesting, this last fact, especially when we consider that with fact 6. So these say the dispersion of firm growth rates has been shrinking, but the dispersion of TFP levels has been widening. So these might look a little puzzling, but as I'm going to discuss later on, our theory directly speaks to these developments and provides a way to reconcile them. So without further ado, let me introduce the important details of the framework that we use to think about these facts. Our model, as I said, builds on the Schumpeterian step-by-step innovation framework. So as is standard in these models, there's a unit measure of product lines, and in each of them there are two firms competing a la Bertrand for market ownership. These firms produce the same, but with different productivity levels. So the firm with high productivity, of course, has a cost advantage and has a higher market share or owns the market. So firms can invest in innovation to improve their productivities. Hence, the variables like market ownership or markups, they evolve endogenously as a result of these endogenous decisions. And the model explicitly addresses or captures the competition margin. Leaders innovate to increase the lead relative to their followers or rivals, and as such improve their markups and profits. And followers innovate with the hope of taking the market ownership in some near future. We complement this standard framework with some additional features. First, we introduce an endogenous entry decision of firms. We allow for multi-step productivity gap between firms instead of the unit step gap in the standard model. And then we add this knowledge diffusion channel, as I mentioned, which allows followers to quickly catch up with the firm. Yeah. So let me illustrate quickly the dynamics that are generated by these innovation decisions in the model. So here, I show just 5 example product lines from this unit measure. The circles are, of course, the leaders, the squares are the followers, and the first line shows a line where the firms are neck and neck with similar productivities. As you can see, the gaps are heterogeneous and change endogenously. So let's see how innovation decisions affect those. Let's see. So this one is showing how a leader innovation changes the gap in the economy. When a leader innovates, it just opens up the gap by one step. So increases the gap, therefore the profits and the markup it can charge. When a follower innovates, it can be of two types. It can be incremental, just closing the gap by one step, or it can be drastic. And that drastic or that this quick catch up can also happen at an exogenous rate. So it's like learning. It's not just based on the own R&D, but it's like learning from the frontier. And that we call knowledge diffusion. And this will be one of the key parameters that we focus on. Entry works in the same fashion, or like in a similar fashion to followers, except that it forces the follower that it replaces to go out of business, so it generates exit. But again, an innovation by the entry can be of incremental type or of drastic type. So just to summarize these relationships in this slide, which is the only slide with some equation in this presentation, but just to highlight the channels that we're going to focus on. So this first beast is the value of a leader in the economy. So the flow value is equal to the profits that the leader charges, which is taxed by a constant rate. And again, here M is basically the gap. The higher is the gap, the higher the profits. Then the R&D cost is supported by an R&D subsidy. What happens is if the leader innovates, it improves the gap by one step. If the leader or entrant innovates, there is some depreciation in the firm value. And if there is knowledge diffusion, the follower just quickly catches up, and they become neck and neck, and the leader just loses the competitive edge. And in the entrant problem, the important thing is there's an additional entry barrier that weighs on the entrant innovation cost. So these will be the first four, or like the main four parameters that we're going to focus on in our quantitative analysis, like the tax rates, subsidies, knowledge diffusion, and the entry barriers. So before I go into the results, let me briefly explain how we calibrate or like how we map this model to the data. So basically, we assume that the model economy starts from an initial BGP that kind of reflects the pre-1980 US economy, after which we see a break in most of these trends. Then we try to mimic the transition of the US economy in the following decades, using or introducing shocks to the four main channels that I just mentioned, like taxes, subsidies, entry costs, and knowledge diffusion. Then we use this calibrated model over the transition for two sets of exercises. First, we introduce shocks to each channel in isolation to understand like their implications. And then we look at the calibrated model, and we shut down each channel one by one to understand like their quantitative explanatory power when it is contrasted against the variables of interest. So just to highlight the calibration results, these panels compare the model implied transition to the data, with the black lines being generated by the model. Basically, for here I show it for entry, employment share of young firms, markups, and profit shares. And as you can see, the model fairly successfully captures like the dynamics of the US economy. And finally, this calibration indicates that over this past about 3 decades, there was a 60% increase in entry barriers and a 60% decline in knowledge diffusion. And the changes in R&D taxes and subsidies we can just read off from the data basically. So let's see our quantitative exercises. So the first exercise again will be introducing shocks to each channel one by one. So and then compare the implications or like the model generated variables to what we observe in the data. The first column shows the direction of the change in each variable in the data. And now, for the sake of this exercise, we're going to introduce the changes in the corporate tax rates or R&D subsidies, just reading up from the data, and to discipline changes in entry cost and knowledge diffusion in separate experiments, We're just going to force the model to mimic the entry rate in the data. So let's see. So when we introduce lower corporate tax rates, what we observe is there is little variation or dynamics in the data. So these flat lines don't mean that there's no change, but what they mean is the response is quite muted. And a similar thing happens when we in our experiment with the higher R&D subsidies, as we observe in the data. With the higher entry costs, again, as we could expect, we see a bit more variation in entry-related variables. But what is striking is that when we consider lower knowledge diffusion, it not just we observe changes in the correct direction, but they have also some substantial or considerable magnitude. So this experiment, comparing channels one by one, indicates that a decline in knowledge diffusion could be a likely culprit behind these observed trends. But again, the question is, like, if we calibrate the model, allowing the 4 channels to vary altogether, whether the data will put enough emphasis on lower knowledge diffusion. It could be that lower knowledge diffusion can potentially explain these, but maybe in the calibrated model, or the calibration will suggest there is little change in that parameter. So let's see our results on the calibrated on that second experiment. But before that, let me explain a little bit the difference between these different channels. So the distinct feature of knowledge diffusion and its implications hinges on this direct effect of a decline in delta in knowledge diffusion. So this direct effect is basically a distortion to the competition between 2 incumbent rivals, like the leader and the follower. So when there's a decline in this parameter, the market leaders are directly shielded from being copied by the followers. So that translates into stronger market power and a bigger lead over rivals. Basically, now being protected against being copied or learned from, the leaders, or the followers are learning with a lower intensity from the leaders, so they start falling behind. And as a result, the productivity gap between the leader and the followers opens up. And also, of course, this composition shifts to more concentrated sectors in the economy. All these together allow the leaders, which are now protected from this threat of being caught up, to charge higher markups. As a result, the profit share of GDP increases, the labor share goes down. But observing these changes, the forward-looking entries get discouraged as well, which implies a lower entry in the economy. And overall, with discouraged rivals and lower entry, the leaders now feel less pressure in their entrenched positions. As a result, they relax as well and experiment less. And finally, overall, we observe a lower dynamism in the economy. And again, going back to the empirical trends that I was mentioning, here what we observe is as the leaders get protected, the productivity, like the level of TFP gets wider, because now the followers can catch up with a lower intensity, but at the same time feeling less threat, and like leaders feeling less threat and followers not being able to catch up and getting discouraged, the overall dynamism declines and the dispersion of growth rate shrinks as well. So this is how the model basically reconciles the widening dispersion in levels, but the shrinking dispersion in growth rates. And basically, the second experiment based on the calibrated model also corroborates our findings. Basically, when we shut down, the experiment here is shutting down each channel one by one. By that, I mean keeping the parameter of each specific channel at the initial BGP level and looking how much we lose in terms of the explanatory power of the calibrated model. Again, this experiment suggests that most of the changes in the model are accounted for by the lower knowledge diffusion and this delta parameter. We go further, looking at some other channels that have been discussed in the literature related to some of these facts, like ideas getting harder to find, or interest rates being low and favoring the leader incumbents, or weaker union power. So we can capture these trends with some parameters in the model. Again, what we observe is that these parameters play some role for some of the trends, but if you want to understand the trends in a joint fashion, lower knowledge diffusion still survives like this horse race as well. So this is basically the main finding of the paper.
Sina, you have 2 minutes.
Yeah, thank you. And just to finish these 2 minutes on a note on the weaker knowledge diffusion or the symptoms that we observe in the US data, let's look at what happens in the patenting data. First, we observe again over these past several decades, the share of patenting by entrant firms has been on a steady decline. By entrants, we mean firms that patent for the first time. And the share of patents registered by these firms has been on a steady decline, as you see. All the while, the share of patents registered by firms that own top 1% of patents in the economy has been on a steady rise. So the firms with the highest knowledge stock or patent stock have been producing more and more. And not just that, they were also reassigning patents to their firms, like buying patents from the secondary market at a higher intensity as well. So apparently, we also observe some hoarding of knowledge or patents in the hands of firms that own the highest patent stock already. So this suggests some evidence of anti-competitive use or abuse of intellectual property, which would be consistent with the increasing use of patent tickets in the economy as well. Again, there could be other reasons driving weaker knowledge diffusion in the economy, which we discuss in the paper, like the shift of production to more data-dependent processes or increasing regulation or even foreign outsourcing. But here we provide many more details or like evidence on how the intellectual property market could be a driving force. So just to conclude, basically we provide a quantitative machinery to understand mechanisms that drive the recent decline in US business dynamism, and our findings suggest us to focus on the distortions, direct distortions in the post-entry environment, like in the competitive environment between leaders and followers, which also has some dire consequences for forward-looking entrants. Therefore, we believe that policy should try to alleviate these distortions. And let me conclude here. Thank you very much.
Thank you very much, Sina. Great paper, very enlightening. Then a pity we don't have time to have a long discussion on it. We have other opportunities. Then thank you very much. Now it's time to move to the second presentation, which is Francesca Vinci. Francesca, the floor is yours.
Hi, everyone. Just sharing the screen. For some reason. Second. Okay, there we go. Okay, you should be able to see the screen. So hi everybody, and thank you very much for the invitation. Today I'm presenting this paper with joint with Omar. Before we start, one thing just I need to stress is that I'm an ECB employee, and therefore I need to stress that the views expressed today are only mine and do not also belong to the ECB. So the paper is called Switching Track After the Great Recession, and hopefully in a second you know what we mean by that. So the starting point here is the idea of economic recovery. What is this process, and what's the understanding that economists have of this process? So if we think about, we look at data before the Great Recession, this is GDP in the US, this red line, but you could also look at advanced countries. What you would see would be a negative shock, GDP falling down, and then a temporary acceleration of growth to go back to the original path, the original trajectory, which means that, which is commonly known as a V-shaped recovery. So there's a negative shock, but then there is no impact on the long-term trajectory of the economy because the shock essentially is transitory. And this view also means that the underlying productive capacity of the economy, which we can call potential output, is not generally affected by recessions. And that means that we can separate the study, let's say, of business cycles and the study of long-term growth. And then the methodology used to measure potential output, to come up with estimates of this, also takes this view, and there's kind of a separation and no effect from business cycles to estimates of potential output. And also the theoretical notions that we use, the mathematical assumptions that we use in models, will also represent this. So if you think about a Cobb-Douglas, a standard neoclassical technology to represent the aggregate production process, which is used in many models, this will have diminishing returns to the inputs of production. In the paper, we'll focus on capital, so let's explain it talking about capital. So if you have diminished returns to capital, it means that if you have less capital because of a negative shock, you're going to have an incentive to invest more because the return to capital is going to temporarily increase. And that incentive to invest more will mean that you will rebuild the capital and you will go back to the original starting point. And so there won't be a long-term effect from the transitory shock. And in this context, monetary policy is then aimed at smoothing the cycle and making sure that those fluctuations are small, but the fluctuations themselves don't have an impact in the long run. And potential output is still this measure that needs to be built. But if we look at what happened during the Great Recession, and here I'm just adding data here at the end of the sample, what you see is that GDP went down, but then you don't see this temporary acceleration in growth to go back to the original growth trajectory. You see it staying on a lower path. And if you think about this underlying potential output as a train, you can see it switching track in conjunction with the crisis. And this fact actually caught the recession, caught the profession by surprise, because if you can have what's called an L-shaped recovery, so this dynamic up here, then it means that recessions can have an effect on potential output. And not only this looks like a change in potential output, but if we look at the estimates of potential output actually published in the United States as the recession and the recovery were happening, what we see is a downward revision of the estimates of potential output. So this is GDP, and these dotted lines are the estimates of potential output published at the beginning of each year. And what you see is that in 2007, the CBO believed that the economy was going to behave like this in the future. This was going to be the path of GDP. But then over time, this got revised down and down and down until the output gap closed, but not because GDP did a V-shaped recovery and went back, but because there was a revision of the estimate of potential output. This is what we mean by the switching track. The change in the beliefs over potential output from policymakers. Now, why am I telling you this? Because the aim of this paper is to build a model that can have both, that can generate both L-shaped and V-shaped recoveries. And the idea is to doing so using endogenous growth theory. Sina was already talking about model endogenous growth, and I think the thread that this whole session shares is the idea of using this type of models, endogenous growth models, to explain many trends and many dynamics that we observe in the economy. And here we're doing exactly that. And we're focusing on the dynamics of economic recovery. And the reason why endogenous growth model can be useful to think about this problem is that in an AK economy, which is the simplest case in this type of endogenous growth model, if you have a negative shock to capital, you do not get a V-shaped recovery. And the reason for that is that the mathematical assumption implies constant return to capital. So you have less capital, you don't have an incentive to invest. And therefore, you can generate an L-shaped recovery. And the contribution of these papers, though, is to show that with this technology, you can also get V-shaped recoveries. And that is once you take into account the stimulus that comes from monetary policy. So what we're going to show is that if you have a large recession with a revision of potential output estimates, you get an L-shaped recovery. But if the recession is not as bad and there's no revision of potential output, you can actually get a V. And this would behave more in line with a Cobb-Douglas technology, essentially. But with this technology, with the endogenous growth technology, with monetary policy, you get both V and L, essentially. And one thing to stress is that throughout the paper, we will talk about the destruction of productive capacity, which we are talking about in terms of capital. But measuring capital is tricky because there's no aggregate series that captures well the variations in the depreciation rate over the business cycle, as well as productive capacity of capital, because the measures that are published by authorities are normally perpetual inventory method, which means that it's cumulated investments with a constant depreciation rate. But we're a bit in luck, because there's this paper by Lanteri, this is an AR paper, and what he found was he collected data for transactions of capital goods and found that the ratio of the value, which is the price of used relative to new capital, actually fluctuates procyclically. And this is what I'm showing here on the right. And what you can see is that there is a very large negative realization in conjunction with the recession, which means that we can think about this as evidence of the fact that the productive capacity of existing capital depreciates in recessions. And we're going to put this into our model. Then, just to give you an overview of the model, we start with a standard DSG with financial frictions. We build on Bernanke, Gilchrist, and Gertler, and also Cristiano, Rosagno, and Motto. There's a representative household, which is hit by a confidence shock. Essentially, we're shocking the demand for consumption. There's a production sector, and here there will be standard TFP shocks as well as risk shocks, which come from the Cristiano framework and are shocks to the demand for capital. Then a monetary authority, which will be entirely standard, just following a Taylor rule, but will introduce this idea of the switching track, which means that the potential output measure will be revised down using past GDP data, using the data that the central bank will observe. Then where we change a key assumption is within the intermediary firm within this model. So everything else is standard, but if you notice here, this is the production technology at the firm level. If you ignore this term, that's the standard COP targets. But this K here is the learning by doing component, which is a measure of knowledge freely available to all firms, which cumulates the learning by doing and is proportional to the aggregate capital stock. And what that means is that the more capital there is in the economy, the more productive each firm is. It's an endogenous TFP component. And if we set this parameter eta to 1 minus alpha, in aggregate, we get the AK technology. And this is the key assumption where we modify the standard ESG framework to generate an L-shaped recovery. Because here, if you shock capital, the return will be constant, and therefore there won't be this incentive to invest more that you will get with a COP targets. So the L-shaped recovery really stems from this assumption. And another aspect of the model that I need to talk about are the entrepreneurs, and these are the firms that demand capital in this model. And these entrepreneurs acquire capital, and then after they've acquired capital, they draw an IID idiosyncratic productivity omega, which is distributed at F of omega with mean 1 standard deviation sigma. But the important thing here is that in order to buy capital, they combine their net worth, which are cumulative profits, but they also need to borrow, so they take a loan. Then they use the capital, they rent it out to intermediate producers, and then after production, they resell it. But what's important here is that since they draw their productivity omega after they borrowed in order to buy the capital, there's a payment threshold omega bar such that if the omega they drew is large enough, if it's above omega bar, so if they're productive enough, then they keep part of the profits and then they continue to the next period. But if the omega they drew is too low, they won't be able to repay the loan, and that means that they go bankrupt. And this F omega bar in this framework is the probability of bankruptcy. And here we are borrowing directly from the Cristiano framework by saying that by using this idea of the risk shock. So if you increase the sigma, which is the standard deviation of the distribution, you will have a higher probability of bankruptcy. And this translates into a shock to the demand for capital. But where we innovate is that we also link this probability of bankruptcy to the depreciation rate of capital in two ways. The first channel essentially simply saying that the capital of bankrupt entrepreneurs depreciates a bit more than the capital of successful entrepreneurs. And then the second channel is our disruption spillovers. Essentially, what we're assuming is that if in the economy, more firms are going bankrupt, so essentially if things are bad, then everybody's capital depreciates faster. There are spillovers on the productive capacity of the whole economy when things are bad. That's kind of the idea. And that means that in aggregate, our depreciation rate is time varying and increases when bankruptcy is higher within the economy. And this term is also in the model, the ratio of the value of use to new capital, which mirrors the Lanteri data I showed you at the beginning. So we're drawing from evidence found by Lanteri to take into our model this idea that the productive capacity of the economy depreciates in bad times. And just to close the model, the monetary authority, as I mentioned earlier, is perfectly standard. You can see here, this is the Taylor rule, and this is the original Taylor rule, as standard as possible. But where we change something is we add this new idea of the switching track within the measure of potential output, because we are trying to replicate what we saw during the Great Recession, this gradual revision of the estimates of potential output. And we do so by modeling potential output in the model as a moving average of past GDP values. And we're also disregarding the most recent 4 quarters because we saw in the data that it took around a year for the CBO to start revising down. And then there's also a zero rebound constraint. And then we calibrate the model to the United States economy. The calibration is quite standard. Unfortunately, I don't have time to explain too much, but obviously everything is in the paper. And then to look at the Great Recession, we hit the economy with a risk shock and a confidence shock. So essentially, we are shocking the whole demand side of the economy. And then endogenously, this is bringing on capital destruction. And this is because we're linking the bankruptcy rate to capital depreciation. And then we compare how the model does to linearly detrended US data. And in order to discipline the shocks, we're using the estimation of Cristiano. And for the confidence shock, we're using the University of Michigan Consumer Sentiment Index. And this is how the model does compared to data. What you see is that we can get the L-shaped recovery that we saw in the data. The black is data and the purple is our model. You can see the L-shaped recovery, which stems from the technology, but also this idea of the switching track. And the model does quite well on GDP and consumption. On investment, we don't capture this whole fold. This is private non-residential investment. This is total investment. We don't get this V, incomplete V, but we still get kind of the long-term effect. And on the federal funds rate, we don't get the whole zero rebound episode, which is this line down here, because we don't have unconventional monetary policies. But we build a measure to try and disregard unconventional monetary policies, which is this dotted line, and there we're more in line. So we still have a quite long zero rebound episode. And also, we are able to capture the switching track with the model and the data. And you can see here, the gap closes around the same time. But the other contribution of the paper is to show that the model can also generate V-shaped recoveries when the shocks are moderate and there is no switching track. And the recovery is V-shaped unless the shock is very resistant. And just to give you an example, I'm going to show you that a 1% TFP shock, a textbook TFP shock, but in the paper there are also other examples with demand shocks. And what matters here is that having a positive weight on the output gap, which is the standard 0.125, so we're not playing with the parameters compared to what's normally used in the literature, generates the recovery, and its monetary policy does that. And this is what it looks like. So you can see the blue line is the case where there's a positive weight on the output gap. And so GDP goes way back to steady state. There is a V-shaped recovery and there is no impact on the productive capacity of the economy. Whilst when the weight on the output gap is zero, you can see that there's a gap, there's a permanent gap and a new steady state and an L-shaped recovery. And the other thing that's important here to stress is that the mechanics are crucially hinging on the depreciation mechanism. So here is depreciation in the model. As you can see, is time varying, and the blue line lies below the dotted line, which means that with the policy in place, the productive capacity of the economy is being protected by preventing capital destruction. And this is actually a novel channel of monetary policy that, to the best of our knowledge, hadn't really been introduced in any models before. And it's very much in the debate. So last year, when the COVID crisis started, the idea that monetary policy could affect and could protect the productivity capacity of the economy was very much there. And this was probably a consequence of what happened during the Great Recession. And this model can capture this. And this is a quote that Mark Carney said, in this situation, it's disruption, not destruction of supply. A part of our job is to make sure that is indeed the case. And in this model, we get these dynamics.
Francesca, you have 2 minutes.
Yes, and then just to conclude, the last thing I want to say is that in the model, we show that there's this mechanics which can generate V-shaped recoveries. But the question is this mechanic strong enough, not just to give you a V-shaped recovery with a 1% TFT shock, but also with a shock that's in line with past historical data? And the answer is yes. So we calibrate the model to some typical V-shaped recoveries that follow the oil shocks in the United States. We do so by, we look at the 1974 and the 1990 oil shock recessions, and we model them by combining an oil shock, which in our model is equivalent to a TFP shock, and a confidence shock. And what we see is, what you see that up here, and you see that the model, which is the dotted line, behaves very similarly to the data and generates a V-shaped recovery. Here, this blue line is detrended GDP, linearly detrended, and this red line is the output gap published by the CBO. And so you can see both measures give you a V-shaped recovery, and the model does something very similar. And so it means that a standard Chilu rule with no switch in track. So here we're not changing the measure of potential output because it wasn't done before the Great Recession. And this is enough to replicate historical data. So just to conclude, this paper builds a DSG model with dedicated technology to reconcile episodes of V-shaped and L-shaped recovery. And in this framework, monetary policy is very important to figure out how the model is going to behave and where the productive capacity of the economy is going to end up. And we also formalize a new transmission mechanism for monetary policy, which is the destruction prevention channel. So I'm going to stop. Thank you very much.
Thank you very much, Francesca. I'm at the point of saying that's a great paper, but I'm not in the position of saying that. Then better if I just pass the floor to Martin. Thank you very much, Francesca.
Thank you.
Martin.
Thank you very much, Omar. Yeah, can you see the screen?
Yeah.
Perfect. All right, thanks so much, Omar, for putting the session together. And it's really cool to meet you and to meet Francesca and Sina. It's a shame that we're not lying on a beach in Bali, but I guess this will do for today. So this paper relates most closely to Sina's paper, although I think there are some interesting discussion points relating to Francesca's paper in terms of whether what we're seeing now is a secular decline in economic activity or whether the Great Recession is causing this decline in potential output. Maybe we can talk about that afterwards. So this is a paper that tries to combine some of the macro trends that Sina was talking about. I'm going to give a different interpretation to these trends, but I actually think there's some overlap. So I think we'll have some good discussion. So I want to explain 3 macro trends in this paper. The first is that there's been a decline in the growth rate of total factor productivity. In particular, since the mid-2000s, so actually slightly before the Great Recession, global total factor productivity in the United States has grown on average by about 0.5% compared to 1.5% historically. And that's despite the fact that the sort of investments that go into productivity, like research and development, actually increased. So we see firms that are trying to innovate, but somehow this is not translating to growth. And this follows after a decade of above average productivity growth. So 1995 to 2005, there was actually a lot of productivity growth. Simultaneously, there's been a 30 to 40-year decline in business dynamism. And by business dynamism, I mean the process of productive firms entering the economy and growing, or unproductive firms shrinking or eventually exiting the economy. So one measure of that is the rate of entry. the fraction of all firms as a startup, that's gone from 14 to 8%. A different measure is the reallocation rate, which is the sum of job destruction and job creation rates, a measure of churn. That's gradually declined as well the last 40 years. And the final trend is that we have indications that market power is increasing. Now, market power is hard to measure. The theoretically purest measure for it is the markup, so the ratio of prices to marginal costs. There's indications that that's been increasing, especially in the United States. A more direct observable measure is product market concentration, so the fraction of economic activity that is produced by a small group of firms. That's been increasing, especially in the United States, although there's increasing evidence that this is also happening in Europe. But it's less of a pure measure of market power, because very concentrated markets could be very competitive. But overall, it seems to be that these trends have been going on in the US economy, and increasingly there's evidence that they've also happened in Western Europe. So in this paper, I claim that these three trends, so productivity slowdown, decline in dynamism, and the rise of market power, can be jointly explained by the rise of intangible inputs. And by intangible inputs, I particularly mean inputs into production that aren't physically embodied, such as software. If you look at this graph, this is intangible investments as a percentage of value added, which is now about as large as traditional capital investments in fixed assets like machinery. And a large share of that increase is because of the rise of software. So software has increasingly become an important input in production. So in this paper, I claim that intangibles can explain these trends in productivity growth, in business dynamism, and in market power, because intangibles have two features. The first feature is that they reduce endogenously a firm's marginal cost and raise the firm's fixed costs. Now, to get the intuition there, I'm going to give you the example of an airline. So we don't fly as much anymore, but if we were in Bali today, we would have just gotten out of an airplane. So if an airline wants to scale up its operation, right, it has fixed assets, it has tangible assets like planes, as well as intangibles like the booking system that you might use to buy your ticket or a seat on the seat map. If the airline wants to double the size of its operations, it needs twice the number of planes to do that. But this booking system can be scaled up almost at zero marginal cost, right? Once you've built the software, maybe you need a bit of extra server space. But so intangibles, because they can be duplicated almost for free, they reduce the firm's marginal cost, but you don't have to pay for the intangibles, right? So regardless of what you produce, so they raise your fixed costs. That's feature one of intangibles. And the second feature is that firms differ in the efficiency with which they deploy them. And by that, I mean that there are persistent differences in the amount of marginal cost reductions that firms are able to achieve for a given spending on intangibles. There's a whole literature that shows that. It shows that this is a firm feature. It's specific. It's persistent. Firms are persistently different, both in their IT and intangible adoption, as well as in their IT productivity. For this paper, I'm going to be agnostic about why that is. So I'm just going to say there's going to be some high IT firms and there's going to be some low IT firms. Some firms are Amazon and some firms are your local bookstore. And we're going to consider that a feature of intangibles. So what I show in this paper is that an input with these two features is going to produce these trends that we see in productivity, market power, and dynamism. Now, to do that, I'm going to add intangibles to a rich endogenous growth model with creative destruction. In this model, I'm going to introduce a group of high intangible efficiency firms. So I'm going to introduce a group of superstars, a group of firms that is good at using IT. And then I'm going to see what does the model predict for what happens over time with productivity growth, with business dynamism, and with market power. Now, to give you the mechanism in a nutshell, let me tell what happens in this model. So this is a model of growth through creative destruction. It's a Schumpeterian growth model, like Agion's work, like Ashijit and Kerr. So it's a modern endogenous growth model. And in these models, firms innovate by developing higher quality versions of goods that other firms produce. And we usually think of that as a sort of quality ladder. So a firm that produces a good is able to produce it at some level of quality on the quality ladder. Then when a different firm innovates, it jumps to a higher point on the quality ladder. So it can produce the same good at a higher level of quality. And that's more attractive to the consumers. So consumers move away from the incumbent's goods and start demanding the good by the other firm. Now, intangibles change that because they introduce a trade-off between quality and price. Because imagine that the incumbent in the market is Amazon, which is good at using these intangibles to reduce its cost, then even if there's a really innovative entrant that tries to become the new market leader, Amazon, because it is able to produce so efficiently, can undercut the innovator on price and therefore prevent this process of creative destruction to occur. All right, so that's the mechanism here. It relates a bit to what Sina Atish was saying earlier, because what's going to happen is because there's no creative destruction, so because Amazon stays in place, there's basically no way for the entrant to get the quality of Amazon, right? So there's no diffusion of what Amazon was doing, and this undercutting process is going to be the driving force. So it's a paper with empiricals analysis as well as theory. There's empirics based on microdata for France and for the US. I'm going to show you some of the results in a second if I have time, but I can already see that 15 minutes is short. The body of the paper is an endogenous growth model with heterogeneous firms that I structurally estimate. I won't tell you too much about the details. The big picture, though, is that this model, with just one shock, right? So the only shock is introducing some very productive, high IT firms into the economy. Eventually, it's going to slow down productivity growth substantially below the initial steady state. It's going to lead to a big reduction in dynamism, and it's going to lead to an increase in markups and a slight increase in profits, although firms do have to cover the large fixed costs of intangibles. But in between, so these are steady state results, in between there's actually going to be a booming growth, because as these high intangible firms enter the economy, they're going to produce more efficiently than their predecessors. So initially there's a booming productivity growth, as we saw in the 1990s, but because these firms are also able to demand higher markups and to be more profitable, wages aren't going to benefit, right? So it's going to be a disjoint growth of wages and productivity. All right, so this shows you that I've done my homework, but one of the paper is actually is Sina's paper. So I did want to show this slide here. So quickly, in terms of the empirical analysis in the paper, it's based on microdata. It's data for the US based on Compustat, so listed firms. For France, I've got access to basically the full tax records of every single company, small, large, as well as R&D surveys, data on what sort of IT systems that they have installed. So I can use that to test some of the assumptions in the model a little bit more precisely. So what I show in the paper is that fixed costs have been increasing. So what I do for that is I compare firm markups and profits. So markups give you marginal profits. It's the ratio of prices to marginal costs. But if you just look at a firm's profits, right, so profits divided by sales, that gives you average profits. So if you know the marginal profit and the average profits, then under some assumptions, you can back out what's happening with fixed costs. Because that's what drives a wedge between those. So if I compare for France and US firms what happens with their markups and what happens with their profits, you see that markups have increased much more than actual profits. And from that, I infer that fixed costs have been on the rise quite substantially. So there's about a 50% increase in fixed costs in the US, about 100% increase in France. So intangibles or fixed costs seem to be more important, and this is basically happening across sectors in the economy. And what I can look at the micro level is whether this correlates with the sort of IT systems that firms have installed. So I observe whether you have enterprise resource planning, and then I see that a firm that has that sort of software indeed has higher fixed costs. So you see that the mechanisms of the model seem to apply. Right, so there's a bunch of other pieces of analysis in the paper, but if you want to see that, I'll have you read the actual work. Just quickly, the model in a nutshell: it's a model in the Clatocortum spirit. So that means that firms produce multiple goods. If they want to produce more, they have to invest in research and development. And if they successfully invest in R&D, in research and development, they innovate and they get a patent that allows them to produce a good at the level of quality at which the previous firm produces, plus some random steps. So they become better at producing the good than others. And so the big trade-off is that even if firms have the highest level of quality, high intangible firms, so Amazon, Microsoft, right, these big incumbents, are going to be able to undercut these firms on price and prevent creative destruction from happening. So to give you the mechanism in the model in a bit more detail, in this model, firms like Amazon, so these high intangible firms, are going to be very innovative. And that's because they can produce goods at lower costs, right? So they have higher profitability, they want to produce more. So Amazon here is going to start a supermarket, an airline, they want to do everything. So initially, when these firms enter the market, there's a booming growth, and it's great. It's good for growth. And these firms stay very innovative in the model. So in this model, in the end, in the new steady state, R&D as a percentage of GDP actually increases. It increases by 60%, which is exactly what you see in the data. But they reduce growth because they have a negative externality on other firms. So they will invest a lot, but other firms are going to invest very little. And that dispersion of R&D, so this concentration of innovation in a smaller group of firms, is going to cause this slowdown in growth. And therefore, unless all firms are good at intangibles, which you don't see in the data, the rise of intangibles, if it's unequal, can actually have a negative effect on growth and can have a negative effect on welfare. Right, so I do this all properly. I structurally estimate the model, calibrate it to a bunch of micro moments, and then the shock in the model is that I'm going to introduce a group of high intangible firms in the US. Now, if I do that and I compare the world before and after the shock, I'm going to be able to explain all of the trends. So there's going to be a reduction in productivity growth, despite the fact that there's going to be more R&D, there's going to be a reduction in entry, and there's going to be a big increase in the markup. And what the model shows is that this one shock doesn't just explain these things qualitatively, but also quantitatively. So with that, I have 1 minute, so I'll just give you 2 more slides. This is the transitional effect. So we start in a world where there's no intangibles. Firms are using similar low levels of it. And then we have the shock where from some point on, say in the 1980s, we introduce these high intangible firms into the economy. So we get the entry of Amazon and the likes onto the market. So initially, these firms create a boom in productivity growth, which lasts about 5 or 6 years as these firms produce more efficiently than previous incumbents. But over time, there's a slowdown because they negatively affect innovation by everyone else. And that causes productivity to fall below this initial level of productivity growth. So you get a slowdown in productivity growth below the initial level, which is negative for welfare. All right, so again, trends in the paper: slow productivity growth despite high investments into innovation, fallen dynamism, and a rise of market power. I explained that through the rise of intangibles because they reduce marginal cost and raise fixed cost and are used unequally across firms. And so the big message is that intangibles can have negative effects on welfare if they are sufficiently inclusive. So if there's a subset of firms that invest a lot in these intangibles, it negatively affects welfare and it negatively affects growth because they have this negative externality on other firms.
Thank you very much, Martin. Given that you saved a few minutes, then let me ask you a question. I have the feeling that Sina's paper and yours somehow, even if modeling with a different mechanism, work on the same direction. In Sina's paper, it's a decline in knowledge spillovers that somehow generates a decline in business dynamism. In your case, it's this switch towards highly intensive R&D firms or intangible capital firms that generate a negative externality. That is somehow the same nature. Then what are your reactions to my comment?
So, well, I agree. I mean, these are related papers. I do think there are big differences in terms of the actual implications of the model. So, I mean, I love Sina's paper. I think there's room for, there's more papers. I showed you the slide. I think there's room for all of them. There are different implications. So in the model that I have, the firm that ends up producing statically is the firm that you want to see producing. And that's because they're the most efficient firm. they're also the most innovative. So it's not as if these firms are lazy, right? So the reason that there's a negative effect on welfare is that they have a negative externality on other firms, on firms that are unable to use intangibles so efficiently. So the implications, for example, for competition policy are really unclear, because cutting up Amazon in this model is not going to do anyone any good, right? Whereas I think if you believe Sina's story, where it's actual prevention of diffusion, right? So say anti-competitive behavior by market leaders and proprietary patenting, it's much clearer what the policymakers should do, right? So I think in terms of actual implications, there's actually quite some differences.
Okay, thank you very much. Unfortunately, we started a couple of minutes late. We are finishing 2 minutes late because thanks to Martin, we just recovered a little bit of our delay. I would like to thank the speakers very much. It was a great session. And I would like to thank the attendants too. Then, well, thank you very much all and have a nice day.
Thank you.
Thank you. I was still curious what Sina was going to respond, Omar, to the comment.
Let's him talk. I think we are, but